fundsupermart.com.
Hello everyone. Concerns over the prospect of EM debt investments continue to shock global markets. Today we have Helene Williamson, Head of Global Emerging Markets Debt of First State Investments, to share with us her views. Hi Helene, thanks for joining us. In recent times, emerging market countries seem to be exposed to negative cyclical effects. Are their long-term structural growth trends still intact?
Yes, you're absolutely right that emerging markets is clearly there's some cyclical is facing some cyclical headwinds. I think the ones are first of all that import growth in the advanced economies is not is flat, so their demand for their exports is not that high anymore. That has led to lower growth rates generally in emerging markets. And the second thing is clearly that capital flows into emerging markets have gone down last year, and that's primarily portfolio and credit flows, not so much foreign direct investment. And the third element has been clearly that commodity prices have sold off a lot, and a lot of emerging market countries are commodity exporters, so that has clearly hit them. So I think those are the negatives for the emerging markets. On the positive side, though, and that doesn't get a lot of press because I think the press prefers stories which are which are negative rather than positive. I think on the positive side, you still have very very low leverage for the emerging market countries as a whole. So they have debt to GDP of roughly 34%. And that compares with advanced economies of 100%. So clearly they still have very low leverage. I think the other thing is that generally speaking, emerging market countries have very good demographics compared with the advanced economies. So their pension liabilities and healthcare liabilities are much less than those of the advanced economies. I think generally policies have been, a lot of countries have been stress tested over the last year, and most of them have done the right thing. They've raised policy rates, they've tightened monetary policy, so a number of them have done very well.
In view of the recent Russia-Ukraine conflicts, how will the crisis impact the economic outlook of both Russia and emerging markets as a whole?
Mm-hmm. We don't think it's going to spill over into the emerging markets as a whole. Russia does not have very strong trade links with other emerging markets. Russia's trade is primarily with Western Europe. So we don't think that is going to spill over into the emerging markets as a whole. Clearly, the conflict has affected the Russian growth rate and Ukrainian growth rate. Ukraine will need to do, the IMF has announced a program yesterday, and they will need to do some very serious structural reforms which will hit their growth rate. We also believe that Russia, because obviously capital outflows are likely to accelerate. So, and the central bank has had to raise interest rates to 7%, which also means that the growth rate in Russia will be lower this year than one would have expected 6 months ago.
What are the key factors that you will consider when identifying investment opportunities within the EM space?
Mm-hmm. First and foremost, for us, we like to invest in countries or companies which are on an improving credit trend, so where we see an improvement in credit quality, because that implies that the risk premium as the credit risk gets less, the risk premium will sink. We also like to do that primarily when we see a long-term improvement which is not priced in yet. So, for example, at the start of this year, we were very bullish on the Eastern European countries because they're very integrated into the global supply chain, and they have shown very good export growth rates to Germany. Also, for example, countries like Romania have a structural reform program which, in our view, was not fully priced in by the market. So we like to identify countries which are an improving trend, and one where the valuation does not reflect yet the improvement we see in the coming months.